We welcome in Nancy Tengler, CEO, CIO, Laffer Tengler. Thank you so much for being here, Nancy Tengler. Great to see you. We haven't chatted in a while. Wanted to know your market outlook as we're bumping up against that 5,900 level on the S&P. What say you?
Nicole, it's so good to see you. Well, I would say a couple of things. We've been steadily buying in the face of all this muck that we got from the tariff turmoil, et cetera. And we've been adding, much like your previous guest from CFRA, we've been adding to a number of the technology names. But overriding that are two things that I think are super important. One is the actual Schwab Trading Activity Index, which shows that it does, as you know, it doesn't just show sentiment from retail trade investors, but it also shows what they're buying and selling. And so we've got a low that we haven't seen in over 2 years in terms of bearishness in the underlying investor. That's usually bullish for long-term investors when the sentiment is so negative. And then share buybacks are back with a vengeance. We saw in the first week of May about $116 billion in buybacks announced, which tends to put, and that was 25% above the previous week. That puts a floor under stocks. And I think that is whether you like buybacks or not, it does perform a function. And so I think we're going to continue to see volatility, Nicole, because we know this administration is good at volatility. But I think we're also in a secular bull market, and that will continue not just from generative AI names and tech, but from the old economy companies that are pivoting to the new technologies.
So I know you've been actively trimming some names. I'm going to get to those in a moment, but the ones that you've been actively buying in the muck, on the dips, on the pullbacks, dollar cost averaging, whatever you want to call it, what are some of the names that you've been buying there? I guess for a longer term, you're trying to hold these at least 12 months, I guess. What names have you been buying?
Yeah, so we were adding to Tesla in February, about $240 a share. We're up about 50%. We added to Microsoft right before earnings, and that stock's up about 17, 18%. Palantir at the end of February, it's up about 32. We don't get them all right. We also added to Uber. That hasn't done much. It's up about 5%. From where we added it. TJ Maxx kind of flat. But what we're trying to do is build a portfolio that not only benefits from secular growth, but in some cases we have a dividend growth strategy and a growth at a reasonable price strategy. We're looking for names that have relatively attractive valuations. Dividend growth is important to us in the dividend growth strategy, where we have that's our ETF TGLR. We have about 13% dividend growth on a 5-year annualized basis. And so we're looking for those opportunities, and that's what we use volatility for.
Right, understood. I mean, dividend growers are always a way to get paid while you wait. It's so cliche, but it's the truth. That being said, for the ones you've been trimming, and we're waiting on Walmart for tomorrow, that's a name that you've trimmed. Why?
Yeah. Well, we love the company. It's our poster child for old economy companies that have pivoted to all the new technologies. They've raised the dividend dramatically twice in the last 2 years, well above previous 10 years. But it's fully valued. I mean, it's trading at a pretty hefty multiple. We think a lot of the good news is priced in, and it was, frankly, an enormous overweight in our portfolio. So we still like it. We still hold it. We just trimmed it back and used those proceeds as well as some proceeds from Spotify and Broadcom, all names we still like very much, but they had become outsized positions in our portfolios. So we trimmed them back to add to these other names. That's what you have to do as a portfolio manager. Sometimes it's just better to let them run. We trimmed Apple for years. We probably should have just held on tight, but you can't do that with diversification rules.
Well, look, I mean, also to your point, you got to take some profits, right? Bulls make money, bears make money, pigs get slaughtered. So at some point when you see a stock running up or making a comeback, you take some profits and take some money off the table. Is there anything that has really surprised you in the economic data or what the Fed plans to do or not do here? Because I know you're making the case overall for mid caps. Why is that? When, by the way, the 10-year bond yield hitting some new recent highs. I think it's the highest in 3 months or something. It's at 4.52%. What's the case for mid caps here?
Well, for us, we decided that it was a good time to launch a strategy in the mid cap space, and using our traditional valuation metrics we use in the large cap names. And there's a couple of reasons. It tends to be a sweet spot for M&A activity. It tends also to be a group that's not going to get crunched by tariffs necessarily. And it's been a place where historically we've seen better returns than in small cap. So I think our clients want to have exposure to U.S. markets in various capitalization ranges, and I like the mid cap space a lot better than the small cap space. And so we've launched it. It's focused on GARPy kind of names, and there's a few names that I can talk about, but effectively what we want to continue to do is invest in AI and get some of the emerging technologies that you don't have access to in a large cap strategy.
I also like that you said they could also be used in the acquirer, the target, growth at a reasonable price. You're saying, I like how you said GARPy. In the meantime here, we might have some more deal making coming in the next 6 to 12 months. Yeah. So mid caps may be exactly where it's at. You mentioned you might give us some names in the group. What are some of your favorites there?
Well, so just in an interest of offering a diversified group of names, Rockwell, though it's run quite a lot, is in the sweet spot really of automated manufacturing, and it will benefit from continued and ongoing reshoring. They had some troubles about 6 months ago, and they've come back very nicely. It's a really well-managed company, one that we wanted to have as a core holding in the portfolio. Duolingo, dominant position in language learning, a subscription-based model, which is always good for software-driven kind of companies, and so very low attrition rate. So, yep, some of these are a little bit pricey, but in this environment where we expect to see secular growth continue, we're willing to pay up somewhat for some of the names. And the last one's an old economy name, Iron Mountain, which is using their storage business to fund their digital storage business. And so we think that presents some interesting opportunities, solid dividend, interesting dividend growth. So while that's not required in this portfolio, it's always welcome.
All right, Nancy Tengler, great to see you, CEO, CIO, Laffer Tengler. Thank you. Good to see you. Thank you so much, Nancy Tengler.